Post-labor economics explained. 7 core concepts you need to know. Post-labor economics explained. 7 core concepts you need to know. Instead, there's a completely new economic dynamic emerging called post-labor economics. In the next few minutes, you'll learn its 7 core principles and how they could reshape your wallet in an AI world. But first, we need to understand exactly why our current system is broken. The problem traditional economics can't solve. Picture this. You wake up tomorrow, and half the jobs in your city have vanished overnight. Not because of a recession or natural disaster, but because AI and automation finally reached the tipping point. Sound like science fiction? Many experts warn automation could displace millions of jobs in the coming decade. We're not talking about a gradual shift over generations. We're talking about a fundamental transformation happening faster than our economic systems can adapt. Here's the problem that keeps economists awake at night. Every economic model we use today assumes something that's becoming less true every day. That human labor remains essential to production. Our entire framework for understanding prosperity, growth, and wealth distribution starts with the idea that people work jobs and earn wages. But what happens when that foundation crumbles? Traditional economics doesn't just struggle with this question, it has a complete blind spot. Our economic health metrics all assume humans work. They break down when machines take over core tasks. When productivity goes up, we expect wages to follow. When companies grow, we expect them to hire more people. These assumptions worked for centuries because human labor was irreplaceable. You needed people to farm, to manufacture, to transport goods, to provide services. Even when machines helped, humans remained the core component. But AI changes everything. For the first time in history, we're creating systems that can think, learn, and adapt. They're not just replacing physical labor, they're replacing cognitive work too. As AI tools review legal documents in seconds and fleets of self-driving trucks roll out in tests, retraining programs can't keep pace. We're not just automating repetitive tasks anymore, we're automating judgment, creativity, and decision-making. So when politicians and economists suggest job retraining as the solution, they're missing the scale of the problem. Sure, some workers can learn new skills, but can we retrain 50 million people fast enough to keep up with AI development? The math doesn't work. AI improves exponentially while human learning happens linearly. A trucking company can deploy autonomous vehicles across their entire fleet in months. But retraining those drivers for entirely new careers takes years. Education faces the same scaling problem. We're telling students to prepare for careers that might not exist by the time they graduate. Computer programming was supposed to be automation-proof, but AI now writes code better than many human developers. We keep moving the goalposts for what counts as safe human work, but AI keeps leaping over every barrier we set. Meanwhile, something fascinating and troubling is happening to wealth distribution. Companies using AI are becoming incredibly productive. They're generating massive profits with fewer employees than ever before. But those productivity gains aren't flowing to workers. They're concentrating at the top. A tech company can serve millions of customers with a handful of engineers and vast server farms. The servers don't get paychecks. Automation profits flow to shareholders, not displaced workers. Hence the gap between record-high stock markets and stagnant wages. This is why we're seeing the strange phenomenon of rising productivity alongside stagnant wages. Companies are getting more done with fewer people, but the benefits flow to capital owners, not workers. It's not a bug in the system, it's exactly how our current economic framework is designed to work. The trucking industry offers a perfect case study. Self-driving trucks will eventually move freight more safely and efficiently than human drivers. That's genuinely good for society. But what happens to the 3.5 million Americans who drive trucks for a living? Our current system says they need to find new jobs. But find new jobs doing what? If AI can drive trucks, it can probably handle lots of other transportation and logistics work too. Legal research presents another telling example. AI systems can now review millions of documents and identify relevant precedents faster than teams of lawyers. Law firms love this technology because it cuts costs and improves accuracy. But junior lawyers who used to build careers doing document review suddenly find their entry path blocked. The profession still needs experienced attorneys. But how do you get experience if AI handles all the entry-level work? Here's the fundamental question we're avoiding. Why are we still thinking in terms of jobs, when the real issue is how wealth gets distributed? The obsession with full employment made sense when human labor was essential to production. But if machines can do most of the work, maybe the goal shouldn't be giving everyone a job. Maybe the goal should be giving everyone a share of what the machines produce. Traditional economics treats this as a temporary disruption. Retrain workers, create new industries, wait for the market to adjust. But that approach assumes we're dealing with normal technological change, like the shift from farming to manufacturing. This time is different because AI doesn't just replace specific skills, it replaces human cognition itself. We're not automating our hands, we're automating our minds. The urgency of this problem can't be overstated. We're racing toward mass technological unemployment, while our political and economic leaders offer solutions designed for the old economy. Job training programs, minimum wage increases, traditional welfare, these are band-aids on a system that's fundamentally breaking down. They might buy us time, but they don't address the core structural shift happening beneath our feet. Without a new framework, we're heading toward a society where a small class of capital owners captures all the benefits of automation, while everyone else fights for the remaining human-only jobs. That's not just economically inefficient, it's a recipe for social chaos. History shows us what happens when prosperity concentrates too heavily at the top, while the masses struggle. The results aren't pretty. So, if neither job, retraining nor knee-jerk welfare fixes work, what else could? Post-labor economics offers a completely different approach. Instead of fighting automation, it embraces the productivity gains and asks a better question. How do we design systems where everyone benefits when machines do the work? The solution isn't more jobs, it's better ownership. But before we explore that framework, we need to address the elephant in the room that most people think of when they hear post-labor economics. Why this isn't about universal basic income. When most people hear post-labor economics, their minds immediately jump to universal basic income. I get it. The idea of getting money without working sounds exactly like UBI. But that assumption misses the entire point of what we're actually talking about. UBI and post-labor economics are fundamentally different approaches to the same problem. And understanding that difference is crucial to grasping why one might work while the other creates more problems than it solves. Universal basic income is essentially a modernized welfare program. The government collects taxes and redistributes that money to citizens as monthly payments. It's a top-down solution that requires constant political support to maintain funding levels. Think about what UBI really means. You're dependent on government decisions about how much money you deserve, and that money comes from taxing other people's economic activity. If the economy shrinks or political priorities change, your UBI payment could disappear overnight. Post-labor economics takes a completely different approach. Instead of giving people money, it gives people assets. Instead of creating dependency on government transfers, it creates ownership of productive resources. The guiding philosophy emphasizes minimal government intervention and market-based solutions. When you own a share of a solar farm or receive dividends from a local investment fund, you're not getting charity, you're collecting returns on assets you actually own. The psychological difference between these two approaches might seem subtle, but it's actually enormous. Consider how you feel when someone gives you money versus when you earn money from an investment. UBI keeps you thinking, I need a handout. Post-labor economics makes you an investor. That mindset shift changes everything about how people relate to their economic security. You're not a recipient of someone else's generosity. You're an investor collecting your share of productive returns. The sustainability problems with UBI become obvious when you think about the math. As automation eliminates more jobs, more people need UBI payments. That means higher taxes on the remaining workers and businesses, which creates political pressure to reduce benefits or find new revenue sources. It's a system that gets more expensive exactly when society can least afford it. Meanwhile, the automated economy keeps producing wealth, but UBI creates no mechanism for regular people to own pieces of that productive capacity. Asset ownership works in the opposite direction. As the economy grows and becomes more automated, the assets you own become more valuable. If you own shares in companies using AI, you benefit when that AI makes those companies more profitable. If you own pieces of automated infrastructure, you earn more as that infrastructure serves more customers. The system gets stronger and more valuable as automation advances, rather than getting more expensive and politically difficult. The political realities around these two approaches couldn't be more different. UBI faces massive resistance because it looks like welfare expansion, requires tax increases, and grows government power. Conservative voters hate the dependency it creates, and even many liberals worry about the cost involved. You're asking people to support a system where the government takes more of their money and gives it to other people. That's a tough political sell under the best circumstances. Asset ownership appeals across the political spectrum because it leverages market mechanisms instead of fighting them. Conservatives like it because it promotes private ownership and reduces government dependency. Progressives like it because it addresses wealth inequality without creating welfare programs. Business owners can support it because it creates new customer bases with actual spending power. ESOP companies like Publix have successfully shared ownership with workers for decades without federal mandates, proving the model works in practice. So what really matters? Ownership, not income. Here's the deeper insight that changes everything. The problem isn't income distribution. The problem is ownership distribution. Our economy produces incredible wealth, but most people own none of the assets that generate that wealth. They rely entirely on selling their labor, which becomes less valuable as automation advances. Instead of trying to redistribute the income that flows from asset ownership, we need to redistribute ownership of the assets themselves. Think about how wealth actually works for rich people. They don't get wealthy from high salaries. They get wealthy from owning assets that appreciate in value and generate ongoing returns. Stock portfolios, real estate, business equity, intellectual property. These assets produce money while the owners sleep. The wealthy understand something that most people don't. Income from assets is more stable and scalable than income from labor. Post-labor economics asks a simple question. What if regular people could access the same wealth-building mechanisms that rich people use? What if you could own shares of the businesses you shop at, the infrastructure you use, and the resources in your community? What if those ownership stakes generated automatic dividend payments that grew over time as the economy became more productive? This isn't about replacing capitalism. It's about expanding access to capitalism's wealth-building tools. The market mechanisms that create prosperity already exist. We just need to design systems that let more people participate as owners, rather than just workers or consumers. Employee stock ownership plans prove this can work at the company level. Community investment funds prove it can work at the neighborhood level. County endowment funds could prove it works at the regional level. The implementation path for asset ownership also makes more political sense than UBI. You don't need to pass one massive federal program that costs trillions of dollars. You can start with pilot programs in individual counties or states. You can use existing legal frameworks for trusts, cooperatives, and investment funds. You can build on successful examples rather than creating entirely new institutions. Banking systems already handle dividend payments, investment management, and asset ownership. The infrastructure exists to track ownership stakes, distribute returns, and reinvest dividends automatically. We're not inventing new technology or creating new institutions. We're connecting existing tools in new ways to serve broader populations. Most importantly, this approach creates positive feedback loops that strengthen over time. As more people own productive assets, they have more incentive to support policies that help those assets grow in value. As communities build local wealth funds, residents become more invested in their area's long-term success. As businesses share ownership with customers and employees, those stakeholders care more about the company's performance. The system becomes self-reinforcing rather than politically fragile. What we're really talking about is a fundamental shift in thinking. Instead of trying to preserve employment in an automated world, we embrace automation and focus on sharing its benefits. Instead of expanding government programs, we expand market participation. But here's what might surprise you about this vision. We're not starting from zero. The asset revolution hidden in plain sight, the foundation for post-labor economics, already exists all around us. We're not talking about building entirely new systems from scratch. The infrastructure, the legal frameworks, and even working examples are hiding in plain sight. We just haven't connected the dots to see how these scattered pieces could form a complete economic revolution. Over 6,400 U.S. firms operate ESOPs, giving 14 million workers real equity stakes. These aren't experimental startups or progressive co-ops. We're talking about major businesses like Publix Supermarkets, Winco Foods, and King Arthur Baking Company. Workers at these companies don't just earn paychecks. They own actual equity shares that grow in value as the business succeeds. When a Publix employee retires, they often walk away with six-figure nest eggs built entirely from company stock they earned through working there. What makes ESOPs fascinating is how they prove ownership-based income actually works at scale. These companies compete successfully against traditional corporations, while sharing wealth directly with their workforce. Employees think like owners because they are owners. They care about customer service, efficiency, and long-term growth in ways that hourly workers at competitor companies simply don't. The model works so well that ESOP companies typically outperform their traditionally owned competitors in both profitability and employee satisfaction. But here's where it gets interesting. ESOPs only scratch the surface of what's possible with asset ownership. What if you could earn equity stakes, not just from working at a company, but from shopping there? That's the concept behind Patron equity, which takes the ownership model beyond employees to include entire customer bases. Think about how much money you spend at your favorite businesses each year. What if a small percentage of that spending earned you actual ownership shares instead of just loyalty points? This isn't as radical as it sounds. Every cashback credit card and airline miles program already operates on a similar principle. You spend money, you earn rewards. Patron equity replaces short-term cashback with long-term equity growth. Instead of getting 2% cashback that you spend immediately, you might earn shares worth 2% that appreciate over time as the business grows. The psychological shift here is enormous. Loyalty programs train you to maximize short-term rewards. Patron equity trains you to think about long-term business success. You start caring whether your favorite restaurant expands to new locations, whether your preferred retailer improves their supply chain, whether local businesses in your area thrive or struggle. You become invested in outcomes beyond your immediate transaction. Communities could even earn dividends from public resources, land, spectrum auctions, carbon credits, or city data trusts. These assets already exist. Governments already control them. In many cases, they're already generating revenue through fees, leases, and auctions. The question is, why shouldn't citizens receive direct dividends from resources they collectively own? Technology has made all of this possible in ways that would have been impossible just a decade ago. Fractional ownership used to require expensive legal structures and complex management systems. Now, blockchain technology and smart contracts can automatically track ownership stakes, calculate dividend payments, and distribute returns to thousands of small investors with minimal overhead costs. You can own a fraction of a solar farm, a piece of a data center, or a share of municipal broadband infrastructure just as easily as you can own shares of stock in a public company. Picture what this looks like at the individual level. You wake up each morning and check your dividend dashboard, the same way you might check social media. Your shares in the local grocery store earned you $3.50 last quarter because they opened a new location. Your stake in the county wind farm generated $12.40 because energy prices went up. Your piece of the municipal data trust paid out $8.25 because local businesses paid for access to traffic analytics. Your fractional ownership in the regional carbon credit fund delivered $15.80 because carbon prices hit new highs. None of these amounts seems life-changing individually, but add them up across dozens of different asset classes, compound them over years of reinvestment, and multiply them across millions of participants. And you're talking about a fundamental transformation in how wealth gets distributed. Instead of hoping for wage increases or government benefits, you're actively building a portfolio of ownership stakes that generate money while you sleep. This approach leverages capitalism's greatest strength, its ability to efficiently allocate resources and generate wealth. But it addresses capitalism's greatest weakness, the concentration of ownership among people who already have capital. We're not destroying market mechanisms, we're expanding access to them. We're not replacing private property, we're making more people property owners. The beauty of this system is that it gets stronger as automation advances. When AI makes businesses more productive, your ownership stakes become more valuable. When robots reduce operational costs, your dividend payments increase. When technology creates new industries, you can own pieces of those industries from the beginning. Instead of being displaced by progress, you benefit from it. What we're really talking about is turning every citizen into a micro-investor with automatic dividend streams from multiple sources. The tools already exist. The legal frameworks are in place. Working examples prove the concept. The question isn't whether this is possible. The question is how we systematically connect these scattered examples into a coherent economic framework that serves everyone. But to understand how this transformation could actually happen, we need to look at the specific mechanics of how ownership sharing works in practice. Employee and customer ownership models. Let's look at how this actually works when you get specific about employee ownership. Research on ESOP outcomes shows companies like Publix supermarkets operating one of the most successful employee stock ownership programs in America. When you work there, you don't just earn a paycheck, you automatically receive company stock as part of your compensation package. No complicated investment decisions or financial planning required. The company handles everything, and your ownership stake grows based on your salary and years of service. When longtime Publix employees retire, they often walk away with retirement accounts worth hundreds of thousands of dollars, built entirely from stock they earned by working there. Winco Foods tells a similar story, but with even more dramatic results. This employee-owned grocery chain has created more millionaire baggers and cashiers than probably any other company in America. Workers who started in entry-level positions 30 years ago now own stock worth over $1 million. They didn't get lucky with crypto or real estate speculation. They just kept working and kept accumulating ownership shares in a well-run business. The company prospered, the stock value grew, and the employees benefited directly from that success. What makes these companies fascinating is how employee ownership changes workplace behavior. When you own part of the business, you care about things that regular employees often ignore. You notice when customers seem unhappy. You think about ways to reduce waste and improve efficiency. You support decisions that help the company grow, even if they require short-term sacrifices. Employee owners at these companies consistently report higher job satisfaction and stronger commitment to their workplace than employees at traditionally owned competitors. But here's where it gets really interesting. What if we could expand this ownership model beyond just employees to include customers. As discussed earlier, patron equity transforms how we think about business relationships. Instead of just earning loyalty points or cashback rewards when you shop, you could earn actual ownership shares in the businesses you support with your purchases. The infrastructure already exists to track your spending and calculate percentages. Credit card companies and retailers process billions of transactions daily with remarkable accuracy. Patron equity just changes what you receive in return for your loyalty. When you own shares instead of points, you care about long-term success, not just deals. Consider how this might work with your favorite local restaurant. Instead of just collecting points toward a free meal, your regular dining there earns you fractional ownership shares. When the restaurant opens a second location, your shares become more valuable. When they develop a popular new menu item that attracts more customers, you benefit from the increased business. When food costs go up and they need to raise prices, you're more understanding because higher margins improve your dividend payments. The network effects become powerful as more businesses adopt patron equity models. You could accumulate ownership stakes across dozens of companies you regularly interact with: your morning coffee shop, your grocery store, your favorite clothing brand, your internet provider, your bank, your insurance company. Each relationship becomes an investment opportunity rather than just a transaction. You build a diversified portfolio of small ownership stakes simply by living your normal life and shopping at businesses you already support. The business case for companies adopting these models is actually quite compelling. Customer acquisition costs keep rising. As digital advertising becomes more expensive and competitive, businesses spend enormous amounts trying to attract new customers and retain existing ones. Patron equity offers a different approach. Instead of spending money on advertising and promotions, companies can share ownership stakes with customers who demonstrate long-term loyalty through their purchasing behavior. This creates much stronger customer relationships than traditional loyalty programs. Points and rewards can be copied by competitors. Ownership stakes create genuine financial alignment between customers and businesses. When customers own shares, they have real incentives to recommend the business to friends and family. They become advocates who want to see the company succeed because their personal wealth depends on it. From the company's perspective, patron equity can actually reduce costs while improving customer retention. Instead of paying for expensive advertising campaigns or giving away free products through loyalty programs, businesses can share ownership stakes that cost nothing upfront but create long-term value for both parties. Customers get assets that appreciate over time. Companies get customers who care about business success beyond just getting good deals. The scaling potential here is enormous. Imagine earning dividends from every business you regularly interact with. Your monthly dividend statement might include payments from 20 different companies across various industries. Some months, the payments are small, but they compound over time as your ownership stakes grow and the businesses become more successful. You're not dependent on any single company or industry for your dividend income. You've got a diversified portfolio built through normal consumer behavior. This approach also creates interesting community effects. When local businesses adopt patron equity models, residents accumulate ownership stakes in their own neighborhoods. Your economic success becomes tied to your community's success. You care more about supporting local businesses because you literally own pieces of them. You pay attention to local economic development because it affects your personal wealth. You become an advocate for policies and decisions that help local businesses thrive. The transition from traditional loyalty programs to patron equity doesn't require revolutionary changes to existing business models. Companies already track customer purchases, calculate reward percentages, and distribute benefits. The legal frameworks for employee stock ownership plans provide templates for customer ownership programs. The technology infrastructure exists to manage fractional ownership stakes and distribute dividend payments automatically. What changes is the nature of the value exchange. Instead of short-term rewards that you spend immediately, You receive long-term assets that generate ongoing returns. Instead of thinking like a consumer trying to extract maximum value from each transaction, you think like an investor interested in the business's long-term success. This dual model, employee and customer ownership, lays the groundwork for broad participation. But individual business ownership is just the beginning. What happens when entire communities start thinking this way about their shared resources and local development? Community investment and local wealth fund. There's a neighborhood in Seattle where residents created their own investment fund that lets them profit directly from local real estate appreciation. You can buy in for as little as $10, and every quarter you receive dividend payments based on how well your neighborhood is doing economically. Here's how it works in practice. Residents pool small investments in local projects, real estate, businesses or urban farms, and earn quarterly dividends. But instead of owning pieces of distant corporations, you own pieces of your actual neighborhood. When property values rise, rental income increases or local businesses prosper, you receive quarterly distributions that reflect your community's success. The psychological impact of literally owning a stake in your neighborhood's success transforms how you think about local issues. When the city council debates a new development project, you're not just considering whether it might increase traffic or change the character of your area. You're also thinking about whether it will generate revenue for the community investment fund you own shares in. When local businesses struggle, you care about their success because their prosperity affects your quarterly dividend payments. You become an advocate for smart growth and good governance because your personal wealth depends on community success. The accessibility of these programs changes everything about who can participate in wealth building. Traditional real estate investment requires tens of thousands of dollars and sophisticated financial knowledge. Community investment trusts lower the barrier to entry so dramatically that anyone can start building wealth through local ownership. You might begin with a $10 investment, add $25 the next month, and gradually build a meaningful stake in your community's economic future. This isn't charity or government assistance. It's market-based wealth building made accessible to regular people. Your personal wealth now tracks your neighborhood's growth, rather than the performance of distant corporations you know nothing about. When your neighborhood attracts new businesses, your investment fund benefits. When local infrastructure improves and property values rise, your quarterly dividends increase. When community development projects succeed, you profit alongside your neighbors. You're not just hoping your area gets better, you're financially invested in making it better. Community investment funds can invest in an incredibly diverse range of local assets. Local businesses looking to expand can receive funding in exchange for equity stakes. Infrastructure improvements that generate revenue, like parking structures or community broadband networks, become investment opportunities. Mixed-use developments that combine retail, office, and residential space create ongoing rental income streams. Even renewable energy projects like community solar farms can generate both environmental benefits and financial returns for fund participants. This model keeps wealth circulating within the community instead of extracting it to distant shareholders and corporate headquarters. When residents invest in local assets through community trusts, the profits stay local too. Those quarterly dividend payments get spent at local businesses, creating a multiplier effect that benefits everyone. The grocery store owner sees more customers with spending money. The restaurant down the street gets more business. Local service providers find more demand for their work. Even residents who don't participate in the investment fund benefit from the increased economic activity. These trusts operate with low buy-in requirements, local voting rights, and simple charters that residents can understand. Investment committees typically include neighborhood representatives who review potential projects based on community priorities. This democratic approach means that investment choices reflect community values rather than just financial returns. You might prioritize projects that create local jobs, improve environmental sustainability, or enhance neighborhood character. Here's why this matters for everyone, not just fund participants. Local investment creates jobs and business opportunities that benefit the entire community. When the investment fund helps a local entrepreneur expand their business, that creates employment for neighborhood residents. When fund money goes toward infrastructure improvements, that enhances property values for all homeowners in the area. When community investments attract new businesses and services, everyone enjoys better amenities and more convenient shopping options. The economic benefits spread beyond the investors to improve life for all residents. What makes this model especially powerful is how it scales beyond individual neighborhoods. Multiple communities can create regional investment networks that share resources and expertise while maintaining local control. Successful investment strategies can be replicated in other neighborhoods with similar characteristics. Fund managers can develop professional expertise in evaluating local investment opportunities while remaining accountable to community stakeholders. The infrastructure for managing these funds becomes more efficient as more communities adopt similar approaches. The track record of successful community investment funds proves this isn't just theoretical. Neighborhoods that have implemented these programs report higher levels of civic engagement, stronger local businesses, and more stable property values compared to similar areas without community investment initiatives. Residents develop stronger social connections because they share financial interests in community success. Local businesses receive more support because customers know they own stakes in business prosperity. Property values tend to be more resilient during economic downturns because the community has organized systems for supporting local economic stability. But neighborhood-level investment funds are just the beginning. The same principles that make community trusts successful could work at much larger scales. Instead of depending on distant corporations or federal government programs for economic security, entire regions could build wealth through organized ownership of public assets. The infrastructure exists. The legal frameworks are proven. The question is whether we're ready to think bigger about who gets to own the resources that generate wealth in our communities. The legal framework for community investment trusts already exists through established structures for REITs, cooperatives, and investment funds. Securities regulations provide clear guidelines for how these funds can operate while protecting investors. Banking systems can handle dividend distributions and reinvestment options automatically. Technology platforms make it easy to track ownership stakes, communicate with fund participants, and provide transparent reporting on investment performance. The tools needed to implement these programs are readily available. County-level wealth funds and public assets. What if your county could create a permanent endowment fund that pays every resident automatic dividends, just like Alaska does with oil revenues? This isn't some futuristic fantasy. Counties across America already own massive amounts of underused public assets that could generate ongoing revenue streams for residents. Underused public assets, from forests and water rights to broadband data, could seed local wealth funds. The question isn't whether counties have valuable assets. The question is why we're not turning those assets into dividend-paying investments for the people who actually own them. Alaska has paid residents $1,320 annually since 1982, turning oil into a lasting endowment. No means testing, no complicated applications, no bureaucratic hurdles. You live in Alaska, you get your dividend check. The fund has been operating successfully for over 40 years, proving that wealth funds can provide economic benefits directly to residents using public resources. What makes this model brilliant is that it transforms a depleting resource into a permanent source of income that grows over time. But oil isn't the only asset that can fund permanent endowments. Counties everywhere sit on valuable resources they could monetize through lease agreements, royalty payments, and concession fees. County-owned forests could generate revenue through sustainable timber harvesting, carbon credit sales, and recreational leasing. County water rights could produce income through careful management and strategic partnerships. Even municipal broadband networks and green energy projects could become dividend-generating assets that provide ongoing returns to residents while serving community needs. Here's where it gets really interesting. Counties generate enormous amounts of valuable data through municipal services that currently goes unused. Traffic patterns, utility consumption, permit applications, property assessments. and economic activity data all have commercial value. Instead of giving this information away for free or letting private companies profit from it, counties could create data trusts that aggregate and anonymize citizen information for commercial licensing. The revenue from data licensing flows into the county wealth fund, creating dividend payments for residents who generate the valuable information in the first place. The governance challenge requires creating transparent, accountable management that serves residents rather than special interests. This means establishing independent boards with a mix of elected representatives and financial experts who follow strict rules about investment strategies and payout formulas. Professional fund management ensures that county assets get invested wisely for maximum returns. Local oversight ensures that investment decisions reflect community values and priorities. Immutable public ledgers can ensure every dividend payment is transparent. Professional fund management combined with local oversight maximizes returns while maintaining community control. Fund managers bring expertise in asset valuation, investment strategy, and risk management that most county governments lack. Internally, they know how to evaluate potential investments, negotiate favorable terms, and optimize portfolio performance. But they operate under strict guidelines established by locally elected oversight boards. Residents vote on major asset acquisitions, board appointments, and payout policies. The professional expertise handles day-to-day operations, while democratic participation ensures the benefits remain rooted in community priorities. The reinvestment strategy creates a growing wealth base that gets stronger over time. Instead of spending all dividend payments immediately, county wealth funds can reinvest a portion of returns to acquire additional assets. This creates what economists call a flywheel effect. More assets generate more revenue, which funds both higher dividend payments and further asset acquisitions. Over time, the fund grows large enough to provide meaningful economic security for residents while continuing to expand its holdings. The wealth base becomes self-sustaining and continues growing even as original assets appreciate in value. Urban counties can adapt this model through different asset classes that match their resource base. Municipal broadband networks could generate revenue through service fees and commercial data sales. Green energy initiatives like solar farms and wind projects could produce both environmental benefits and financial returns. Public parking structures, convention centers, and municipal buildings could operate as revenue-generating assets rather than just budget expenses. Even urban real estate portfolios could provide rental income and appreciation gains that flow to resident dividend accounts. The democratic element ensures residents maintain control over major decisions affecting their economic future. Annual meetings allow fund participants to review investment performance, evaluate new opportunities, and vote on strategic directions. Residents can propose asset acquisitions, question fund management decisions, and elect oversight board members who represent community interests. This participatory approach means that investment choices reflect local values rather than just financial returns. You might prioritize projects that create local jobs, support environmental sustainability, or preserve community character alongside generating dividend income. This model creates a foundation for economic security that doesn't depend on traditional employment. When your county wealth fund generates meaningful dividend payments, you have income that continues regardless of job market conditions. Automation might eliminate your current job, but your ownership stake in county assets keeps generating returns. Economic recessions might reduce employment opportunities, but your dividend payments provide financial stability during difficult times. The wealth fund becomes a form of economic insurance that protects residents from the volatility of traditional labor markets. Implementation can start with pilot programs in pioneer counties that test different approaches and refine management strategies. Success gets measured through rising economic agency scores, dividend coverage ratios, and resident satisfaction surveys. Counties can use municipal green bonds, philanthropic partnerships, and federal matching grants to provide initial capital for wealth fund creation. The seed capital creates the groundwork for lasting dividend streams that eventually become self-sustaining and continue growing without additional public investment. What makes county-level wealth funds especially powerful is how they keep economic benefits local rather than extracting wealth to distant shareholders. When residents receive dividend payments, that money gets spent at local businesses, creating multiplier effects that benefit the entire community. Local investment generates jobs and opportunities that help everyone, not just fund participants. Property values tend to remain more stable because the community has organized systems for supporting local economic development and prosperity. The legal framework for county wealth funds already exists through established structures for public trusts, municipal bonds, and investment management. Securities regulations provide clear guidelines for how these funds can operate, while protecting public interests. Banking systems can handle dividend distributions and account management automatically. Technology platforms make it easy to track ownership stakes, provide transparent reporting, and facilitate democratic participation in fund governance. The infrastructure needed to implement county wealth funds is readily available and proven through existing examples. County wealth funds scale community investment to the regional level, setting the stage for digital assets next. Instead of viewing county resources as budget items or regulatory burdens, residents see them as dividend-generating investments in their economic future. Instead of depending on distant corporations or federal programs for prosperity, communities build wealth through organized ownership of local assets. But the most valuable assets in the modern economy might not be physical resources at all. Data, spectrum, and digital age royalties. Your data powers trillion-dollar platforms. Imagine owning a share of that value through data trusts. Every day you generate information worth hundreds of dollars through search history, location data, shopping patterns, and social media interactions. Google, Facebook, Amazon, and other tech giants have built massive valuations largely from user-generated data and network effects. They've turned your personal information into their most valuable asset. Yet you receive zero compensation for providing the raw material that powers their entire business model. Think about what this means in practical terms. Every time you use Google Maps, you're helping them improve navigation algorithms and gather real-time traffic data they sell to other companies. When you shop on Amazon, your browsing and purchasing behavior helps them optimize recommendations for millions of other users. Your social media posts train AI systems that get licensed to businesses around the world. You're essentially working as an unpaid data laborer for some of the most profitable companies in human history. The concept of data royalties treats your personal information like intellectual property that deserves compensation. Just like musicians earn royalties when their songs get played, or authors receive payments when their books get sold, you should earn money when companies use your data to generate profits. This isn't some radical redistribution scheme. It's basic fairness in a market economy where valuable resources should command payment. Blockchain and smart contracts now enable tiny, instant royalty payments to data owners. Smart contracts can track data usage in real time and distribute payments automatically to data owners. The technical infrastructure exists to turn your daily digital footprint into automatic royalty payments. Municipalities could create data trusts that aggregate citizen information for collective bargaining power. Instead of tech companies negotiating with millions of individuals separately, they'd work with organized data trusts that represent entire communities. These trusts could license anonymized, aggregated data about traffic patterns, energy usage, economic activity, and demographic trends. The revenue gets distributed to trust participants based on their data contribution. This approach addresses privacy concerns, while actually increasing individual control over personal information, because you're part of an organization that has real negotiating leverage. Here's why data ownership could improve privacy, rather than compromise it. Right now, Tech companies collect your information without meaningful consent or compensation. You click agree on terms of service you never read because you have no real choice. If you want to use digital services, data trusts, flip this dynamic. As an owner with economic stakes in your information, you have genuine incentives to understand how your data gets used and ensure it's handled responsibly. Privacy becomes a valuable asset you protect rather than something you give away for free. Similarly, public spectrum auctions and carbon credit markets generate billions. Dividends could go straight to citizens. The electromagnetic spectrum belongs to the public, but governments auction usage rights to telecommunications companies for billions of dollars. Those auction proceeds typically disappear into general government budgets instead of benefiting the citizens who actually own the spectrum. Carbon credits offer similar potential for funding rule-based dividends. As carbon pricing becomes widespread, there's enormous value being created in markets for emissions reductions. Forest lands that sequester carbon, renewable energy projects that offset emissions, and efficiency improvements that reduce consumption all generate valuable credits. Much of this happens on public lands or involves public resources. The global potential of these digital assets sets them apart from traditional resources. Oil, minerals, and farmland are limited by geography, but data, spectrum, and carbon credits can generate value anywhere people use digital services or environmental assets exist. A rural county might have limited industrial resources, but abundant forest carbon credits. An urban area might lack natural resources, but generate massive amounts of valuable data. These intangible assets democratize wealth creation across different geographic and economic conditions. The exponential nature of digital asset value creates increasingly valuable royalty streams over time. As the digital economy grows, the data you generate becomes more valuable because it feeds larger AI systems and serves more users. As environmental regulations tighten, carbon credits become more expensive and generate higher returns. As spectrum becomes scarcer due to increasing wireless demand, usage rights command premium prices. You're not just earning from current asset values but participating in exponential growth trends that compound over decades. Technical infrastructure makes all of this possible at scale. Instant settlement systems can enable rapid clearing of dividends, while open APIs can feed real-time data to personal dividend dashboards. Everything becomes API-driven, with potential for AI integration to automate and optimize the entire process. You could wake up each morning and check your royalty earnings the same way you check social media, seeing payments from data usage, spectrum auctions, and carbon credit sales automatically deposited to your account. Collective purchasing power through financial institutions could make high-value digital assets accessible to regular people. Banks could pool customer resources to invest in data centers, solar farms, and spectrum licenses that generate ongoing royalty payments. Individual customers might own tiny fractions of massive assets, but they'd receive proportional dividend payments as those assets generate revenue. This approach, inspired by collective bargaining principles, allows ordinary people to participate in ownership of digital infrastructure that was previously available only to institutional investors. Municipal green bonds, philanthropic partnerships, and federal matching grants could provide initial capital for establishing these royalty-generating asset pools. A modest universal basic income could provide baseline demand, while digital royalties supplement household cash flow. Wealth funds at county, state, and federal levels could then pay regular dividends, stabilizing demand and facilitating further asset acquisition. Early capital injections create the financial foundation for sustainable dividend streams that grow stronger over time. What we're really talking about is turning the digital revolution into a source of broadly shared prosperity instead of concentrated wealth. The same technologies that threaten traditional employment could become mechanisms for distributing economic benefits more widely. Instead of a few tech companies capturing all the value from digitization, everyone who contributes data, spectrum, or environmental assets could could receive ongoing compensation. The tools exist to make this happen. But how do we actually deliver these dividend streams to millions of people? That's where our existing financial system becomes the key infrastructure for this entire transformation. Banking and financial infrastructure revolution. Banks already handle deposits and payments. They can also aggregate dividends from your asset portfolio. Think about how banks currently process direct deposits, manage automatic payments, and track your spending patterns. That same infrastructure could seamlessly integrate dividend payments from dozens of different assets into your regular cash flow. Instead of waiting for your bi-weekly paycheck, you'd receive daily micro deposits from your stakes in local businesses, community investment funds, data royalties, and public asset dividends. This shift represents a fundamental change in how people think about earning money. Right now, most of us operate with wage-seeking behavior as our primary economic driver. We look for jobs that pay well, negotiate salary increases, and switch employers for better compensation packages. But what if dividend-seeking behavior became the new normal? Instead of optimizing for the highest-paying job, you'd focus on accumulating assets that generate the most reliable dividend streams. You'd evaluate investment opportunities the same way you currently evaluate job offers, asking which assets provide the best long-term returns with acceptable risk levels. Financial institutions would compete on their ability to find and manage dividend-producing assets for customers, rather than just offering the lowest loan rates or highest savings account yields. Banks would develop expertise in evaluating everything from employee stock ownership plans, to community real estate funds, to digital royalty streams. They'd compete on transparency about asset performance, yield-boosting features that compound your returns, and access to diverse asset classes that weren't previously available to retail investors. The bank with the best dividend portfolio management would attract the most customers. Your bank could pool your account's dividends with others to buy bigger asset stakes, like solar farms, so you all earn higher returns. Think of it like a mutual fund, but instead of buying stocks and bonds, you're purchasing fractional ownership in physical assets that generate ongoing revenue. Your $100 monthly contribution combines with thousands of other customers to purchase meaningful stakes in valuable infrastructure that produces dividend payments for everyone involved. This creates an entirely new revenue model for banks, while serving customers who need alternatives to traditional employment. Instead of making money primarily from loan interest and fees, banks could earn management fees from the dividend-producing assets they acquire and maintain for customers. They'd succeed when their customers' dividend income grows, creating perfect alignment between bank profitability and customer prosperity. Banks would have genuine incentives to find the best performing assets and manage them efficiently, because their revenue depends on generating strong returns for customers. Mobile applications could make dividend management as simple as checking your bank balance. Your phone would show real-time updates on dividend payments from various assets, projected monthly income based on current holdings, and opportunities to reinvest dividends into additional ownership stakes. The user interface would be intuitive enough that you wouldn't need financial expertise to participate effectively, just like online banking made basic financial management accessible to everyone. Dividend management apps would democratize sophisticated investment strategies. Competitive dynamics between financial institutions would drive innovation and customer benefits. Banks would compete on transparency by providing detailed reporting on asset performance and fee structures. They'd compete on yield by finding the most profitable dividend-generating opportunities. They'd compete on access by offering customers stakes in diverse asset classes that provide both financial returns and portfolio diversification. This competition would push down fees, improve service quality, and expand investment options for customers who previously had limited access to wealth-building opportunities. The alignment of interests between banks and customers fundamentally changes the banking relationship. Currently, banks often profit when customers take on debt or pay fees for services. Under a dividend-focused model, banks prosper when their customers build wealth through asset ownership. This creates incentives for banks to provide genuine financial education, help customers make smart investment decisions, and focus on long-term value creation rather than short-term profit extraction. Customer success becomes directly linked to bank success. Minor regulatory tweaks would make this transition smoother without requiring wholesale restructuring of financial systems. The technology exists to implement these systems immediately. Banks already process millions of direct deposits, automatic transfers, and electronic payments daily. API-driven dividend distribution could integrate seamlessly with existing banking infrastructure. Real-time settlement systems could enable instant dividend payments as assets generate revenue. Customer education becomes crucial for successful implementation. Banks would need to help customers understand how dividend-generating assets work, what risks they involve, and how to build diversified portfolios that provide stable income streams. This educational component creates opportunities for banks to add value beyond just managing money. They become financial partners who help customers navigate the transition from wage-seeking to dividend-seeking economic behavior. The scale potential is enormous once early adopters prove the model works. Community banks could start with local asset pools that serve regional customers. Regional banks could expand to statewide programs that aggregate resources across multiple communities. National banks could create coast-to-coast dividend networks that give customers access to assets across different geographic markets and economic sectors. International banks could eventually offer global dividend portfolios that provide income security regardless of local economic conditions. This transformation positions banks as essential infrastructure for post-labor economics rather than obstacles to economic innovation. Instead of being disrupted by automation and changing employment patterns, banks become the delivery mechanism that makes widespread asset ownership practical and accessible. They maintain their central role in the financial system while serving customers whose economic needs are fundamentally different from previous generations. Imagine opening your banking app each morning to see micro-deposits from everything you own, shifting from paycheck dependence to dividend income. Your account shows payments from the local grocery store you own shares in, the community solar farm your neighborhood invested in, and the data trust that licenses your information. This isn't some distant utopian vision. The infrastructure exists today, but making this transformation happen requires addressing one crucial question that determines whether any of these ideas can actually become reality. Government's new role as market facilitator, who controls the rules that make this transformation possible. Government's role in post-labor economics isn't about expanding control or creating massive new bureaucracies. This is about smart facilitation that uses minimal regulatory changes to unlock massive private sector innovation in asset ownership. Policy tweaks, like tax breaks for share donations and safe harbor rules for micro-dividends, unlock private innovation. The beauty of this approach lies in what economists call regulatory tweaks, rather than wholesale economic restructuring. We're not talking about revolutionizing the entire financial system or creating new government departments. We're talking about minor adjustments to existing laws that remove barriers to asset ownership programs. Safe harbor rules for micro-dividend funds could provide bright-line exemptions from burdensome fund registration when payouts per investor remain below set thresholds. This means as long as individuals aren't making substantial amounts from dividends, the process stays streamlined and integrates into existing financial reporting systems. Tax incentives represent another powerful tool that encourages voluntary participation rather than mandating behavior. Companies could donate shares in exchange for tax deductions, fueling local wealth funds at no net revenue loss. Picture a thriving local business that wants to reduce its tax liability while building community goodwill. They donate equity stakes to the county wealth fund, get a substantial tax deduction, and every time the business profits, local residents receive dividend payments. The company benefits, the community benefits, and government revenue stays stable. This leverages market forces, so conservatives and progressives both benefit. Business owners can support it because it creates new customer bases with actual spending power. Even libertarians appreciate systems that use market forces to distribute wealth more broadly without government mandates or redistribution schemes. The legal foundation already exists through established frameworks for trusts, cooperatives, and investment funds. Employee stock ownership plans have operated successfully for decades under existing securities laws. Real estate investment trusts provide templates for how large groups of small investors can own pieces of valuable assets. Cooperative businesses demonstrate how member ownership creates shared prosperity. We don't need to invent new legal structures. We need minor amendments to existing frameworks that align them with broad dividend distribution goals. Transparency and accountability become essential for maintaining public trust in these new systems. Bond-backed or state-supported funds must publish audited ledgers and real-time dashboards that show exactly how money gets invested and distributed. Clear voting rules ensure that county residents hold majority voting power, keeping benefits rooted in the community. Dividend clawbacks can revoke payouts from corrupt jurisdictions or prevent gaming of the system. This level of transparency actually exceeds what most private investment funds currently provide to their shareholders. Government can seed initial funding for wealth funds through various mechanisms without creating long-term dependency. Municipal green bonds allow counties to raise capital for asset purchases using their existing creditworthiness. Catalytic philanthropy from foundations can provide startup funding that gets repaid as funds become profitable. Sovereign match grants can amplify local investment without requiring ongoing federal support. Counties can use existing assets like public lands or mineral rights to seed funds, allowing residents to buy in through affordable monthly contributions. Here's what makes this funding approach sustainable. The goal is creating self-reinforcing systems that eventually operate independently of government support. Initial funding jumpstarts asset acquisition, but dividend reinvestment and growing membership create ongoing capital for expansion. Government steps back as market mechanisms take over wealth distribution. Think of it like building a dam that generates electricity for decades after the initial construction investment. The Alaska Permanent Fund demonstrates how this works in practice. The state used oil revenues to create an endowment that now pays annual dividends to every Alaskan resident. The fund operates with an independent board, half members elected and half financial experts, publishing audited statements and following strict rule-based payout formulas. Government oversight ensures accountability while professional management maximizes returns. This model proves that wealth funds can operate at scale while maintaining both democratic participation and financial efficiency. Technology infrastructure makes implementation much simpler than it would have been even a decade ago. Instant settlement systems like FedNow can clear dividends in seconds. Open APIs allow real-time data feeds to personal dividend dashboards. Everything becomes API-driven, with potential for AI integration to automate and optimize the entire process. This technological foundation is blockchain-ready, ensuring that future innovations can integrate without requiring major system overhauls. Government's role includes creating a startup ecosystem that supports post-labor economics implementation. This involves providing greenfield opportunities for companies that help governments, banks, and citizens transition into asset ownership structures. First movers can establish platform relationships with counties, firms, and lenders, developing turnkey solutions that make participation as simple as opening a bank account. The market will drive innovation and implementation as successful models prove their value. The regulatory changes needed are surprisingly modest. Streamlined filings can allow mission-driven entities to raise capital and share profits without the complexities of full corporate conversions. Updated securities regulations can accommodate micro-investment opportunities that weren't economically viable under older frameworks. Payment system modernization can handle the high-frequency, small-value transactions that dividend distribution requires. What's especially encouraging is how these changes create win-win-win scenarios, where households, governments, and companies all benefit simultaneously. Households build wealth through asset ownership. Governments reduce social service costs. As residents gain economic security, companies access patient capital and loyal customer bases. Nobody gets rich at someone else's expense. Everyone benefits from shared prosperity generated by productive assets. This approach gives residents genuine economic agency rather than dependence on government programs or employer decisions. People can invest wisely and control their financial destiny through ownership stakes in diverse assets. They become partners in economic growth rather than spectators hoping for better wages or government benefits. With these small tweaks in place, let's map out how post-labor economics could roll out on the ground. The implementation roadmap. The practical pathway follows a 3-chapter story. Pilot counties prove the concept, states scale the systems, and federal adoption creates nationwide implementation. By this strategic approach starts with 3 to 5 pioneer counties with diverse economies, testing different models and refining the systems based on real-world results. We're talking about actual communities implementing wealth funds, tracking performance metrics, and documenting what works versus what needs adjustment. These pioneer counties become living laboratories where residents participate in asset ownership programs, while researchers measure outcomes and effectiveness. Chapter 1 focuses on county-level pilots that demonstrate these programs actually improve people's lives. We'll track resident dividend coverage and satisfaction alongside specific metrics that show whether asset ownership creates genuine financial security. Economic agency scores reveal how much financial control residents gain through ownership stakes. Dividend coverage ratios show what percentage of household expenses get covered by ownership income rather than traditional wages. These concrete indicators help refine the models before scaling to larger populations. Early adopters gain significant competitive advantages that create natural incentives for other communities to follow. Counties implementing successful wealth fund programs attract residents and businesses who want access to ownership-based prosperity. Local businesses benefit from customers who have steady dividend income to spend. Property values tend to rise in areas where residents have diversified income sources beyond traditional employment. This creates what economists call blue ocean opportunities, where first movers establish platform relationships and market dominance before existing institutions adapt their approaches. Chapter 2 involves state-level scaling that creates economies of scale and political momentum. County pilots prove the concepts work and generate support for state-level adoption. State programs make asset ownership more efficient and accessible by pooling resources across multiple communities. Successful state implementations create pressure for neighboring states to offer similar opportunities to their residents. Politicians who support asset ownership programs gain credibility when their constituents experience direct financial benefits from participation. Technology acceleration makes this transition both necessary and possible within the next decade. AI and robotics development creates both the problem that requires solutions and the tools that make solutions feasible. Humanoid robots and white-collar AI will eliminate millions of traditional jobs, making alternative income sources essential for social stability. But these same technologies also free up human talent to build the platforms and systems needed for widespread asset ownership. Advanced AI can manage complex investment portfolios, blockchain technology can track fractional ownership stakes, and automated systems can distribute dividend payments to millions of participants with minimal overhead costs. A startup ecosystem emerges around post-labor economics implementation, creating opportunities for companies that specialize in onboarding governments, banks, and citizens into asset ownership structures. These businesses develop turnkey solutions that make participation as simple as opening a bank account. Financial consultants help counties evaluate their assets and design wealth fund strategies. Technology companies create platforms for dividend management and ownership tracking. Legal firms develop standardized frameworks for community investment programs. This ecosystem generates jobs and economic activity while building the infrastructure needed for broader adoption. Chapter 3 brings federal integration that provides the regulatory framework and infrastructure support needed for nationwide implementation. This progression follows successful policy innovation patterns, where local success stories drive broader political acceptance and institutional change. Federal involvement creates standardized systems that work across state boundaries while maintaining local control over asset selection and community priorities. National coordination enables larger-scale investments and more sophisticated risk management that individual counties couldn't achieve independently. Success stories create powerful political momentum for broader adoption as other regions see the tangible benefits of resident ownership programs. When pilot counties demonstrate rising household income, increased economic stability, and higher community satisfaction, neighboring areas demand similar opportunities. Media coverage of successful implementations builds public awareness and support for expanding these models to additional communities. The measurement systems ensure accountability and continuous improvement as programs expand, with performance tracking identifying which strategies work best under different conditions. Here's why urgency matters. Implementing these systems before mass unemployment becomes a crisis prevents social chaos and economic disruption. Current projections suggest AI and automation could eliminate substantial portions of traditional employment within the next decade. Waiting until unemployment reaches crisis levels makes implementation much more difficult, because desperate populations and strained government budgets create poor conditions for launching complex new programs. Proactive implementation allows for careful testing, gradual scaling, and community buy-in that wouldn't be possible during economic emergencies. The transformative vision points toward a society where ownership replaces employment as the primary source of income for most people. Residents invest wisely and control their financial destiny through diversified ownership stakes in productive assets. Property-anchored economies incentivize sustainable choices because people have long-term stakes in their community's environmental and economic health. Local dividend income rewards community-focused spending and investment, creating resilient regional economies that can withstand global economic disruptions. This transformation builds momentum as successful examples prove the model works. Early adopters refine the systems and create best practices that other communities can adopt. Technology improvements reduce implementation costs and increase efficiency over time. Political support grows as residents experience direct benefits from asset ownership programs. Business participation expands as companies discover advantages in sharing ownership with customers and communities. What makes this roadmap compelling is how it builds on existing infrastructure while creating entirely new economic opportunities. Legal frameworks for trusts and investment funds provide the foundation for community ownership programs. Banking systems can handle dividend distribution and account management with minor modifications. Technology platforms can integrate ownership tracking with existing financial services. The transition leverages current capabilities while opening pathways for innovation and economic participation that weren't previously possible. The startup opportunities multiply as demand grows. For implementation expertise and specialized services, companies that help counties evaluate assets, design wealth funds, and manage dividend distribution become essential service providers. Technology platforms that handle ownership tracking, payment processing, and performance reporting create valuable market positions. Financial institutions that specialize in community asset management gain competitive advantages in serving populations transitioning away from employment-based income. If you're excited by these possibilities, hit like, subscribe, and let us know in the comments where you'd start a pilot program. But stepping back from implementation details, there's a bigger picture here about what this transformation really means for how we think about work, wealth, and human potential in an automated world. Post-labor economics isn't just about surviving automation. It's about thriving in an age of abundance. We're talking about a future where technological progress benefits everyone, not just the owners of capital. Think beyond traditional employment and imagine earning dividends from assets you actually own while robots handle the work. The tools exist today. The legal frameworks are ready. Pioneer counties could start implementing these systems tomorrow. What does this mean for you? Maybe it's time to explore how these concepts might work in your own community. Start conversations with local leaders. Share this video with someone who cares about AI's impact. And let's build this future together. Automation doesn't have to cost us jobs. It can pay us dividends. Which asset would you want dividends from, your city's data, local businesses, or public lands?